In business, an entry barrier refers to any obstacle or restriction that makes it difficult for new companies to enter a particular industry or market. These barriers can take various forms, including the following 5 factors. First, economies of scale. When established companies have a significant advantage due to their ability to produce goods or services at a lower cost per unit than new entrants. This makes it difficult for new companies to compete on price. Second, capital requirements. Some industries require a significant amount of capital to get started, such as the oil and gas industry, which requires substantial investments in exploration and drilling equipment. Third, brand recognition. Established companies with well-known brands have a competitive advantage over new companies that lack brand recognition. Fourth, regulatory restrictions. Some industries are heavily regulated, requiring companies to obtain licenses or permits that can be difficult to obtain. Fifth, intellectual property. Established companies may have a strong patent portfolio or other intellectual property that can prevent new entrants from entering the market. Overall, entry barriers can make it challenging for new companies to break into a market, which can result in a lack of competition and higher prices for consumers. The pharmaceutical industry and energy industry are a few examples of industries with higher entry barriers. For firms in the pharmaceutical industry, developing new drugs requires significant R&D expenses, making it difficult for new firms to enter the market. Moreover, stringent regulatory requirements must be met before a new drug can be marketed. For energy industry firms, the cost of building and operating power plants or oil rigs is very high, making it difficult for new firms to enter the market. Government regulations and licenses are also necessary to operate in this industry. In contrast, e-commerce and food trucks are industries with lower entry barriers. For e-commerce companies, setting up an online store requires relatively low initial investment, making it easier for new entrants to enter the market. Online platforms such as Shopify and Amazon also make it easier for entrepreneurs to launch and operate their own online stores. Similarly, starting a food truck requires a lower investment than opening a traditional brick-and-mortar restaurant. The cost of entry is relatively low and regulatory requirements are less stringent. Now, let's look at the exit barriers, which are the flip side of the entry barriers. An exit barrier refers to a factor or circumstance that makes it difficult or costly for a company to exit or leave a particular market, industry, or business activity. Exit barriers can be both internal or external, and they can arise from a variety of sources, such as financial, legal, or strategic factors. Examples of internal exit barriers include investments in specialized equipment, employee training, or long-term contracts that may prevent a company from exiting a market without incurring significant losses. External exit barriers can include regulatory requirements, customer loyalty, or the dominance of large competitors in a particular market. In general, exit barriers can limit a company's flexibility and make it difficult to respond to changing market conditions or to shift resources to more profitable activities. As a result, companies often need to carefully evaluate the potential exit barriers before entering a new market or industry, to ensure that they can exit the market if necessary without incurring excessive costs. The airline industry is an example of industries with higher exit barriers. Airlines invest heavily in fixed assets such as airplanes, which cannot be easily liquidated in the event of financial distress. They also face high regulatory barriers, which can limit the number of buyers for their assets. In contrast, exit barriers in hospitality businesses such as restaurants, hotels, and bars are generally low. This is because hospitality businesses have minimal fixed assets and can often sell their inventory and equipment to other businesses.